Hello there. Welcome back to Cost and Management Accounting with 5. In this video, we want to look at a question from the question paper of June 2024. And this is question 3 on that question paper. And we are going to calculate various costs that we have there. And if you go to 3.1, it reads the following information was taken from the books of tires manufacturers for the year ending 28 February 2021. So we're given a table that are given there where we're having a variable cost of 80,000 rands, fixed cost of 600 rands, and units produced 4,000 rands. So on the first part, that is 3.1.1, it reads calculate the fixed cost per unit. So what we're going to do is we're going to first of all put down the formula for fixed costs, and then we calculate by substituting the figures that were given in that table above. So basically, fixed costs, we know that fixed costs are the costs that do not vary with the level of production. Whether they produce 1,000 units, whether they produce 0 units, 20 units, we are going to incur the same amount of fixed costs. So that's the basic characteristics that we have in terms of fixed cost. So let's go to 3.1.1 and try to put down the formula first, and then we can come back to look for the elements of that formula. So same 3.1.1. We are saying fixed costs. The formula for calculating fixed costs is equals to formula for calculating average fixed cost is equals to total fixed costs over number of units. Number of units. So if you go back to the table that we are given there, you would see that we are given fixed cost of 600,000. We are given units produced 4,000. So basically 600 is our fixed cost. Units are 4,000. So we can just come here and substitute as such. We are saying 600. We are saying 600. 600,000 representing our fixed costs, and then we divide by number of units, which is 4,000. To do that, we are going to get your 150 units, 150 rands per unit. So this is the answer that we have there in terms of the average. Then we can go to the next question, see what does it require us to do. We are given to calculate the total fixed cost if 8,500 units were produced. If 8,500 units were produced, so you see that the units have more than doubled there. So what does it mean? Remember on the definition of fixed cost, we said it doesn't vary with the level of production. So what does it mean? It means we are going to have the same amount of fixed costs by producing 8,500 with the same that you incurred with 4,000, which is the same 600,000. So we are not going to calculate anything. We're just going to pick the fixed cost that we are given there is 600,000. So what 3.1, 3.1.2, 3.1.2, we are saying it is equal to we are saying it is equal to 600,000 rands. So this is what we have in terms of this 3.1.2. Then we can move on to the next one. The next one we have calculate the variable cost per unit. A variable cost per unit, obviously, we are going to say total variable cost over total number of units, and then the total variable cost we are given it there is we are given it as 80,000. So we have 80,000 is the total variable cost here. And then units produced about 4,000. So basically, we're going to say 80,000 divided by 4,000. So 3.1.3. So we are just calculating average variable cost. And here we've got average variable cost, whereby we are saying total variable cost over total units, of which we are saying total variable cost, we have got 80,000 rands, and then a total number of units, we've got 4,000. So that leaves us with 20 rand per unit. This is the variable cost per unit. So this is what we have. Now we'll move on to the next one and try to see what do we have. Right, on the next one, we're now saying calculate the total variable cost if 9,500 units were produced. And we know that on definition of variable cost says the level, the cost vary with the level of production. As we produce more, we incur more variable cost. So it means we are going to make a direct proportion by saying if 1 unit is cost to 20 rand per unit, what about 9,500? We just multiply 20 times 9,500. Then we get your answer there, 3.1.4. So we have here 3.1.4. We are saying 20 rand per unit, which is this one. Then we multiply by 9,500, which we are going to get as 190,000. So this is what we have in terms of 3.1.4. Then we go to the next one. We have 3.1.5. Please calculate the total cost of production if 3,500 units were produced. Total costs of which we know that total cost is equals to fixed costs plus variable costs. So we're going to calculate fixed costs inside 3,500 plus variable costs inside 3,500. Then we get our total cost. So basically we are saying 3.1.5. 3.1.5. We can just put it here. 3.1.5. We are saying it says total costs equals to total fixed costs plus total variable costs. This is what we have. And we know that fixed costs do not change with level of production. So even in this instance, we know that we have our fixed cost is 600,000 rand, so it's going to remain 600,000 rand. Because the level of production does not matter when it comes to fixed costs. And then variable cost is the one that is going to change, whereby we are having 3,500, and we're going to multiply by 20 rand per unit that we got there. We got that. We know that it's per unit, we got 20 rand per unit. But in this case, we've got the 3,500. So it's a variable, we multiply by 3,500. So 3,500 times 20. So we're going to add 3,500 units times 20 rand per unit. And then we get the total there. Let's just try to see what we get. We say 3,500. And then we multiply by 20. We're going to get 70,000. So it means here we have 70,000. So we are now going to say 600,000 plus 70,000 rands. And obviously this will give a total of 670,000. So this gives us the answer of 3.1.5. Then we go to the second part, which is 3.2. Tires manufacturers provided you with the following information to assist in the calculation of the depreciation. We've got factory plant and machinery gross purchase price, which is 800,000. Depreciation rate at 20% per year. Date purchased 1 July 2020. And calculate depreciation of plant and machinery on 30 June 2022 by using each of the following methods. First of all, let's identify the period in question. We are seeing that this non-current asset was purchased on 1 July 2020, and we are told to calculate depreciation on 30 June 2022. So obviously, after a year, it was now 30 June 2021, and then on 30 June 2022, it was second day. So we have for 2 years that we want to calculate depreciation using straight line and diminishing balance method. Straight line, we're not going to have any problem there. 3.2.1, 3.2.1, we are going to say on straight line, the formula is percentage times cost, as simple as that. And then we check our percentage and our cost. Percentage, we know that our percentage, as we are given there, percentage is 20%. 20% is here. And then the cost is 800,000. So basically, that's how we are going to do it. 20% and 800,000. So we are saying 20% is 20 over 100. 20 over 100, and then we multiply by 800,000 over 1. And then this is over 2 years, multiplied by 2 over 1, representing the number of years here. And then we do that. Let's try to put it in our calculators and try to see what we get there. Right, we are going to get 312,000. That is 3.2.1. Then on 3.2.2, we are seeing that this is diminishing balance method. And you know that the diminishing balance method is more complicated than a straight line. So what we are going to do, you can just say diminishing balance method, diminishing balance method, and this is 3.2.2. So we are going to calculate for the first year and then calculate for second year because it's diminishing. Depreciation varies with years. Depreciation becomes smaller and smaller or less and less as you go by years, since due to the formula. Remember formula, we say it is equal to percentage times carrying value. That's the formula for diminishing balance method, whereby we have to calculate first carrying value, whereby carrying value, we find it by saying our costs minus accumulated depreciation. So during the first year, by 30 June 2021, it was the first year. 30 June 2021, there was a year. So we calculate for that year. Remember, this percentage are given it on annual basis. So on the first year, there was no accumulated depreciation because it was just being bought. So we are not going to have any depreciation there. So depreciation is 0 in the first year because it was just being purchased. So we are just going to say 20% times 800,000 for the first year. So 20% times 800,000. So we are saying 20 over 100 times 800,000. And then we do that, you are going to get your 160,000. This is depreciation for the first year. But for the second year now, by 30 June 2022 now, that's where we are ending. But for the second year, we had depreciation at the beginning of the second year because of this depreciation. So we are now first of all calculating carrying value, whereby we say it's cost minus accumulated depreciation, of which accumulated depreciation that is there. Accumulated depreciation means depreciation from the day we purchased that asset up to today. So after 1 year, we had only 160,000. So that is the accumulated depreciation that we have in the second year. So we are going to say it is equal cost. Our cost is 800,000. We subtract 160,000 to get the carrying value, and then we get what? So that means our carrying value is equal to we say 800 minus 160 is equal to 640,000. This is our carrying value. Then depreciation for the second year now, we are saying percentage, we know that is 20%, so we are going to say 20 over 100 times the carrying value, which is 640,000. Calculate, let's try to see what we get. We are going to get 128,000 rands, which is equal to 120,000 rands. So we now know that for the first year, depreciation was 160. This was the depreciation for the first year, and for the second year, it was 128. So we are going to say total depreciation is equal to 160 plus 128. And you are going to get it as 288. This is depreciation over 2 years using reducing balance method. So this is what we have, guys, according to this video. Hopefully this video was very helpful. We'll meet again in the next video. Stay tuned for more videos to come.